This op-ed you may have heard about apparently is going to get some attention in Washington today. I'm just sort of speculating, and I know that D.C. has devoured the news cycle. However, can we not lose sight of the fact that every emerging market currency is down over the last 6 months? The cryptos are collapsing. Italy's debt just continues to go up, and yet all we focus on every day is inside the Beltway. What else do we need to be watching?
Well, 10 years ago today, it's almost comical. I mean, it's pure comedy. The banks on Wall Street lectured us and lectured us and lectured us again that you had to be overweight emerging markets. Emerging markets had decoupled from developing markets. That's where all the growth was. So you don't want to be in slow growth developed markets. You have to be in emerging markets. This was literally the mantra day after day after day. Here we are 10 years later, and the same group is lecturing us the other way. You've got to be overweight developed markets in the U.S., underweight EM. It makes no sense. It's a colossal failure of common sense.
Well, it's probably, to be fair, Larry, it's probably not the same group. It's probably the same companies, but different people, because you know, yes, you know the half-life of most people on Wall Street these days. That said, here's the bigger question, though. If we're seeing a collapse of the Indonesian dollar or the Indian rupee to all-time lows against the dollar, these are stories that are going to get, page A8 of most coverage. Do they matter in a broader perspective for our viewers who are probably largely invested in the U.S. equity and bond markets? Are they the canary in a coal mine, or are they just interesting side stories?
Well, 75% of global growth today, economic growth, is outside of the United States. 75%. Over 40, close to 50% of S&P 500 profits and sales are outside the United States. So, of course it matters, but what's happening is the cheapness of China, say the FXI or the Crane shares, the K-Web, the cheapness of these emerging markets to the U.S. is literally parabolic like we've never seen before. You're talking about the most extremes ever. And right now you want to be backing up the truck, moving your way into emerging markets and underweight the U.S. because we are coming into a colossal mean reversion in the next 2 quarters.
Why do you think that?
Because, like I said, there's too much global growth outside the United States.
Yeah, maybe they're cheap for a reason, though.
Well,
I mean, we've seen the Chinese market now fall more than 30% in 9 months twice in the last 3 years. The Shenzhen fell 45% in 6 months in 2015. Why should anybody buy into that market when it's already cost us a lot of money twice in 3 years? Okay, well, think about this.
You've got companies like Amazon. Amazon is worth $1 trillion. Tencent and Alibaba are worth $800 billion. So Tencent and Alibaba are 20%, trading at a 20% discount to Amazon. I mean, that's nuts. You've got much more global growth that is affecting those companies. The U.S. is 300 million people. There's close to 1 billion people in Asia. It's growing much faster. So net, the value, you're talking about an extreme value discount in emerging markets relative to developed markets. But most importantly, the Fed is, because all the growth is outside the United States and because Europe, you look at the DAX today, just broke a 5-year major trend line. Because of this weakness overseas, you're going to see the Fed back away from the policy path, and that is going to weaken the dollar, and that's going to create an absolute inferno of energy underneath the emerging market equities.
So wow, and I can't compete with inferno of energy. I like it, but it is a bold call, and a lot of people I know hope that you are right. Inferno of energy.